Hi guys, welcome to today's class. Today we are going to see general economics under that fiscal and monetary policy and what is the meaning, scope and methodology. Now, what is meant by fiscal policy? So, I'll read the definition for you. Fiscal policy is a policy under which the government uses its expenditure and revenue programs to produce desirable effects and avoid undesirable effects on national income, production, and employment. It is very simple. In our home, how our mother or we, when we started earning, when we have to run the family, we will think about how to grow, correct, how to make sure that our future is better, how to make sure that even our all the needs are satisfied, correct. You will check, right? So how we will do, we will save something, we will spend for some purposes, and we try to earn more income, correct. We try to go for job or we try to do business. So it is in a normal life, in our simple life we are doing it. The same way, when a government does it for an entire country, then that is called what? Fiscal policy. When government uses their expenditure or revenue programs, all right, expenditure or revenue programs for what? To make sure that the country is on the growth path, there is an economic development, to make sure there is a favorable impact on the national income, production or employment, right? See here again, fiscal policy refers to the government programs of making both automatic and discretionary changes in what? Taxation, public expenditure on borrowing in order to achieve the intended goals of economic growth, full employment, income equality, and the stabilization of economy in its growth path. It is as simple as that, like how we will run our families, how we will make sure that everybody in the family is good and they are going in a right direction, and our family is going in a right direction. The same way the government uses, there are various policies, automatic and discretionary policies they will use. Say for example, budget, taxes, right? When the why budget, what in the budget what they are doing, they will say we allocated so much, we allocated for this particular region, we allocated for this industry, we are giving some incentives for this type of industry. All right, so they will do, why? Because they wanted what? Overall economic development and a stabilized economy. So when the government does it, then that is called fiscal policy. Now, types of fiscal policy. There are two types of fiscal policy. One is discretionary, the second one is non-discretionary fiscal policy. Now, what is meant by discretionary policy? Suppose if the government aims to expand or to contract the economy, what does it mean? Suppose if the government suppose the economy is in a downturn and the government want to turn into an expansionary stage or wanted to increase introduce an economic boom in the country, then they may follow they may follow expansionary discretionary policy. Suppose the country is in high in inflation, now the government wants to reduce it, the government wants to reduce it, so they will purposefully they will place a policy over there, and that type of policies are called as contractionary fiscal policy. So when there is a particular issue, and for that if the government is aiming at and starting a policy or stating a policy, then that is called discretionary fiscal policy. Usually under that we have two things, expansionary and contractionary. All right, expansionary means when the economy is in downturn, when the economy is in recession, government wanted to bring a boom. All right, government wanted to bring a boom over there. So what they will do, they will introduce certain fiscal policies which will help the economy to come to that stage. So in that, what will happen, the government will keep on spending, they'll increase the government expenditure. How it will improve? Understand, when nobody is taking any, when the private players are reluctant to invest, now government will invest and they will start the production, they will start the construction activity, they increase the public expenditure. So what will happen once the government started production, or once the government started I'll tell you a classic example. Once they started construction, what will happen? They will place for orders and they will recruit people. So because of that, some things are happening. Right? It is a chain of actions. So when the government expenditures are increasing, which means money is getting pumped into the economy, into the country. Money is pumping into the country. So what happens there? A boom will start there. From recession, it will slowly, it will recover. Another thing they can do is reduction of taxes. Why? What is the reason for reduction of taxes? Understand. Suppose if you have 100 rupees in your hand and the tax is say 40 rupees, means then you will have only 60 rupees in your hand to either to save or to consume or to spend. All right. So what happens? You will not spend much. You will save. Even saving will be very less. So what happens? Capital formation will be less, and even consumption also less, because your personal disposal income is what? Less. Personal disposal income means what? Your revenue minus your taxes. So 100 rupees I earned and I paid 40 rupees taxes, and 60 rupees I'm having it in my hand. With this 60 I have to spend, I have to save. If you save only, there will be a capital formation in the banks. Correct. So if you spend only, there will be a demand in the market. So this money is not enough because already the economy is in what? Recession. So now what will happen? Government will reduce the taxes so that your disposable income will be higher. So you can save more or you can spend more, and both in which in turn both will result in what? Little expansion or little boom in the economy. And this type of fiscal policies are called as expansionary fiscal policies. Suppose think it in opposite way. Suppose it is high inflation is there in the country. They wanted to reduce it. They wanted to reduce it because too much of inflation is not good for a economy. All right, a growing country or developing nation. So what they will do? Okay, too much of inflation is there. Let me raise the taxes so that the money in the hands of the people will reduce. Money in the hands of the people will reduce so that their spending will reduce. Correct. Their spending will reduce. Once the spending is reduced, automatically your inflation rate will come down. So these type of fiscal policies are called as contractionary fiscal policies, and these are deliberately aimed to do what? To either to increase or reduce, right, the economic stability. All right. Now next one is non-discretionary fiscal policy. So what does it mean? These are all called automatic stabilizers. These are all called what? Automatic stabilizers. These are all there in the government policies all the time, inbuilt. These are all inbuilt fiscal policies, we can say. For example, transfer payment. Transfer payment means what? Our pension and all those things, unemployment wages, all those things are called transfer payment. Income, corporate income taxes, corporate, these are all there already, and these are all will change according. This is the base, and when there is something needed, and government will pitch in with what? Discretionary fiscal policy. Automatic stabilizers are there. Non-discretionary fiscal policies are there. Whenever there is a need, they wanted to raise a concern, they wanted to point out, or they wanted to aim to do something. At that time, they will introduce what? Discretionary policy, along with which one? Automatic stabilizers. So personal income taxes, all these are all already there. In that, they will do certain changes, certain implications, certain amendments on keeping in mind what they will keep it? Economic stability, they will keep it, and they wanted to maintain a certain level of inflation, or they wanted to reduce the inflation, or the country is in a downturn, they wanted to make it a better. All right. So these are all the different types of fiscal policies. So I repeat, discretionary policy means with the aim to what? With the aim to either improve or either to reduce. All right. With the aim to improve the economic growth, or with the aim to control the inflation. Then in that case, it is called discretionary policy. Non-discretionary policy means these are all called automatic stabilizers. These fiscal policies are there, and they will counteract with what? They will interact with the counterparts of the discretionary policies. So if something happens because of discretionary policies, the counterparts will be answered by which one? Non-discretionary fiscal policy, because these are all inbuilt fiscal policies. Now, what are the instruments of fiscal policy? We know that already. Budget, taxation, public expenditure, and public debt. Budget and taxation. Budget, we know every year the government will do that. Each sector, how much it is giving, how much the government has allocated, what are all the, whether we have a surplus budget or whether we have a deficit budget. Surplus means when our government revenues, when the country revenue is more than our expenditure, then in that case it is a surplus. When there is opposite of that, then that is called deficit. Whether the government has to borrow or whether the government has enough money, how much each sector to be given, how which sector to be prioritized, where to be invested, all those informations will be given where, all those are discussed where, budget. All right, so that is a main fiscal policy which helps the government to do their all their objectives. Next one is taxation. Every year we will come up with what, in the month of February, when the sessions are happening in the parliament, they will amend what, finance act. Why every year they are doing it? Because to check out whether what is required for the current trend. If do we need to give some tax cuts, or do we need to increase the taxes, or how we will work on it, whether we have to follow progressive taxation or regressive taxation. All right, so again taxation will help the government to achieve what, their objective. Next one, public expenditure and public debt. Public expenditure means how much government is spending in the for the country, how much government is spending. Say for example, transfer payments like pension they are giving. Yes or no? That is a public expenditure. Health services they are giving, government hospitals, for that they are spending. It is a government expenditure. Again, public expenditure is an instrument or a tool of what, fiscal policy. If public expenditure increases, then the country, government wanted to pump in the money, or the government wanted to set in a boom or set in a development mode in the economy. Public debt means when the government borrows, how much the government is borrowing. If the government borrows more or the government is repaying it, but that they use the public debt as a what, instrument. If they borrow money, though, then the money supply and they'll control the inflation. All right, if they repay, though, the money is coming back to the economy, and the money supply will increase. All right, so all these things are instruments of fiscal policy. Next one, what are the objectives? Obviously, full employment, price stability, economic growth, equitable distribution, external stability, capital formation, and regional balance. Full employment, yes. Why government is having various investment programs? Why government is spending on, setting up industries and all those things? Because they wanted to generate what, full employment in the country. And price stability. Why they are following, contractionary fiscal policy or expansionary fiscal policy? Why? Because they wanted to either reduce the inflation or increase the inflation. What does it mean, inflation? Inflation is nothing but your price changes. So government wanted what, price stability. They wanted to maintain certain level. And economic growth is the main objective of any government policy. All right, how whether our GDP is increasing, GNP is increasing, people welfare is increasing, their standard of living is improving. All those things are what, the motive of a government. Equitable distribution means whether all the people are getting, whatever they are supposed to. Equitable distribution means, it is, we call that as, income distribution. Income distribution means what, we, in simple language, if I want to tell, there are poor, there is a rich, there is a difference between rich and poor people. So that is what we are talking about here. At least there should be a fair distribution of income among the citizens of India. All right. External stability, they are talking about currency valuation. Even if they wanted to maintain the rupee value externally, and they wanted to maintain, they should not borrow more, they should not borrow, I mean, it is not like keep on borrowing from foreign countries is not good for a company's financial health. And the same way that there is a all due duties there on the government to maintain what, the rupee value. That is called external stability. Capital formation means we have here make in India, made in India, and you save this because capital is very important for starting a industry which provides what employment opportunities. So capital means the investments they are talking about here. So that is a main motive of any government, because if only investments comes only, then we can set up what industries, we can set up companies, then from there we can generate what employment opportunities, and because of that people will start earning and their standard of living will improve, and equitable distribution, or equitable income, fair income they will be achieving. All those things are happening automatically. All right, next one, regional balances. Regional balances means all it is, see, when a country is developed fully means when all the areas or all the sectors are growing together. All right, so that is called regional balance. It is not that one sector will be growing and another sector will be deteriorating. One region will be growing and another region will be deteriorating. There is no point in that. So government always aims at regional balances. All the states, all the districts, all the projects, all the sectors, all the industries should grow together. Okay, these are all the objectives of fiscal policy. Next one is monetary policy. Monetary policy is concerned with what? Changes in the supply of money and credit. So far you have seen fiscal. Now we are going to see monetary policy. As the name indicates, monetary means it deals with what? Money. It deals with what? Money. Supply of money. All right. Now understand here, it refers to the policy measures undertaken by the government or the central bank to influence the availability, cost, and use of money and credit with the help of monetary techniques to achieve specific objectives. So, what does it mean? Basically, monetary policy is handled by the central bank of any country. In our case, it is RBI, to control the money supply, or credit creation. Why it is important? Understand, money supply is very basics for what? Your inflation. Your inflation decides whether the kind of, because if inflation keep on increasing, prices are increasing, which means people will suffer, economy will not grow. Correct. So they have to control. So how it will help? We will see one by one how it will help. So any policies taken by RBI or taken by the central bank to influence what? Availability of funds or availability of money, cost of that money, or use of that money, then that is called what? Monetary policy. Now, what are the tools of monetary policy? Quantitative and qualitative measures. Quantitative means they will follow certain rates, rates, or interest rates, or SLR rates, CRR rates, and so on and so forth. All right. Qualitative means, say for example, RBI will say, priority wise lending, or you have to check the credit worthiness before lending, or whom you have to lend. All those things are what? Qualitative measures. We will see one by one. Now, when we talk about monetary policy, we have so many tools. I have put everything here. We will see deposit rate. Deposit rates means how much you are going to give the rate of interest to your depositors. Guys, what will happen? Why bankers? Please understand the basic thing. See, bank is the mediator between whom and whom? Between the people who has excess money and the people who wants money. All right, people who wants money, this can be for any purpose. People want money for their business, for investment purpose, or for consumption purpose, whatever it is. So bank is the mediator, because people who have excess money, what they will do, either they will invest in the stock market, share market, or they will invest in gold, or they will invest in deposits. So the bank will accept the money. They will not keep that money idle in your account. They will lend it out to make sure the money is multiplying. Your own money money is multiplied in 10 people's hand. All right. Now see here, deposit rate. Again, if the deposit rates are very good, people will come and deposit money in the bank account. So because of that, the capital savings will increase, capital formation will increase, and people who wanted money, they can borrow from the bank at a lesser cost of interest, because funds are available, because people are attracted. Yes or no? So they can borrow. The availability of money will be there. That is called deposit. They will say deposit rates either increasing or decreasing. So both. If they increase, what will happen? If they decrease, what will happen? Both are in the aim to what? Either to increase the money supply or to decrease the money supply. All right. Open market operation. Open market operation means what? When RBI purchases, all right, per open market, it is called as OMO. What does it mean? When RBI purchases or sells, all right, the share, securities to the other commercial banks, then that is called open market operation. So how does it will impact money supply? Understand, when RBI sells, when RBI sells security, so what is happening? The other commercial banks will buy that. Other commercial banks will buy that, definitely, because the interest rates, that returns will be good, and definitely the other commercial banks will buy. So what happens? The other commercial banks, they will buy means their money in their hand is going to whom? RBI. So what happens there? The money base in the hands of the commercial bank, which to be lent to the public, will reduce. So once it is reduced to, then what will happen? Say for example, I'll give you a simple example. Suppose this commercial bank is having rupees 100. RBI is selling a security that value is 50. Now this commercial bank purchased this, so 50 rupees gone to RBI. Now 50 rupees is with whom? RBI. So this money has been taken out from the commercial bank. Now the commercial bank only has how much? 50 rupees. Now with that 50 rupees, they have to lend it. They will lend it for the borrowers. Now what will happen? Will he charge a higher interest rate or lower interest rate for borrowing? Obviously, the commercial banks will charge what? High rate of interest. Why? Because their money in their hands for creating credit is reduced, and because of that, the rate of interest will increase. So once the rate of interest increases, people will be reluctant to borrow. All right, so they will reduce their consumption. They will be very meticulous about their production activity. So because of that, the money supply in the economy will get controlled. Yes or no? Think it in an opposite way. When RBI purchases securities from the commercial banks, all right, well, now what will happen? The money is going from RBI to commercial banks, and in the monetary base in the hands of the commercial bank has increased. So when there are more funds, obviously they will provide at a better rate of interest, and when the money are available at a better rate of interest, people will borrow and they will start a production activity, or they may purchase more. So because of that, that money supply in the economy will increase. All right, so the main aim of RBI for using all this instrument is to what? Either to increase the money supply or to decrease the money supply based on the economic conditions. Bank rate means the rate at which the commercial banks rediscount their bills with whom? RBI. All right, so that rate is called what? Bank rate. When the commercial banks need money, they'll go to RBI. If they have bills, they'll say, please rediscount these bills and give us the money in advance. If the RBI is charging more for that, then definitely the cost of money available in the hands of the commercial banks will be higher. So they will charge again higher rate of interest, and again the same thing follows. If RBI charges lesser rate for this type of borrowing, then the cost of money in the hands of the commercial banks will be less, and they will also give better interest rates for their borrowers, and the effect will keep on following. All right, so all these rates, guys, whatever the rates are, these are all either increased or decreased by keeping in mind what? Either to increase the money supply or decrease the money supply. All right, now Selective credit control is a qualitative measure. They will tell, RBI will tell, okay, for this purpose you can give this much of your entire loan dispersal. You have to give so much for this purpose, so much for that purpose, education purpose, manufacturing purpose, agricultural purpose. So selective credit controls. So to whom you have to give, you have to choose the, you have to follow certain rules. You have to check the credit worthiness, all those things. So these are qualitative techniques which are qualitative tools which RBI used to give guidelines to the banks. Credit authorization. Yes, you have to get authorized. If the certain limit is more, you have to get authorization. So all these are qualitative again. Moral suasion means it is just like a guidance. Don't worry, RBI will say, okay, fine, you carry on, we will do it. If anything goes wrong, we will come and help you out. And they will give you what? You have to do like this, you have to do like that. It has to be in this fashion. They'll keep on giving you advices, guidelines, rules, and regulations. All right. Credit planning. Again, this is a qualitative measures. All these are qualitative measures, guys. Qualitative, and all these are quantitative. Why quantitative means? Because it deals with the rate. Alright, it deals with the rate. Here, though, it is a guidelines, rules, procedures. They'll fix regulations, how the bank has to follow code of conduct, all those things. Alright. Now, credit planning means you have to how you have to plan which sector you have to give how much, what is the rate, and how much you have to give for a particular person. What are all the securities you have to take? All those things are coming under the qualitative techniques. Now in quantitative, we have seen deposit rates, open market operations, and bank rate. We will see the other three. Lending rate means it is nothing but when you go and borrow from the bank, they are charging that is called lending rate. What are the interest rate they are charging? So why if you keep on watching, the interest rates, the lending rates will keep on changing. 1 month it will be increasing, 1 month it will be decreasing. Why so? Why means if the rate of interest increases, definitely the people will not borrow. The people will be very much careful about their borrowings. They'll be very negligent. They'll be very meticulous about their borrowings because the cost of capital is what, or the cost of borrowing is what, high. So they will use it very carefully. They will not use left and right, or they will not use right royally. No, they will use it carefully. So because of that, what is happening, guys? Because of that, that money supply, or the money, whatever the people spend, that is reducing. So because of that, once you start reducing, your demand will reduce. Demand reduces, though it will have impacts on the production and everything. So inflation on the prices also, it will have an impact. So your inflation level will come down. All right. Suppose the RBI wants to increase the inflation, or increase the money supply in the country, then the lending rates will be less. Why? Because if the lending rates are less, then everybody will borrow. So they will borrow for what are the purposes they wanted. You can borrow for a house, or you can borrow for business purpose. You will start doing it. So because of that, what is happening? Money supply is improving in the economy. All right. So all these things are done in a view to maintain what? Price stability, economic growth. Again, the same, whatever the fiscal policy objectives had, the same thing, but the main motto here is they will control this through what? Increase or decrease of money supply in the economy. And who will do this? RBI will do this. Statutory reserve ratio means what? And the cash reserve ratio, both are ratios, the reserve ratios they have to, each commercial bank has to maintain. I'll explain the difference now. Cash reserve ratio means out of the total deposits, how much ever the bank has received, that particular commercial bank has received, a certain percentage they have to maintain in form of what? Cash. With whom? RBI. They have to maintain certain percentage of their total deposits in form of cash. With whom? RBI. Statutory liquidity ratio means what? They are a certain percentage of their total deposit they have to maintain in a form of liquidity investments. Liquid investments. Liquid investments means what? Liquid investments means that can be easily convertible into cash. In the case of emergency, or in case of need, those investments can be sold and they can be converted into cash. Say for example, X bank has received 10 rupees or 100 rupees as a deposit. Now on that 100 rupees, say 6% as cash reserve ratio means, so 6 rupees to be kept as a reserve with whom? RBI. And again statutory reserve ratio is 4% means, then from 100, 4 rupees you have to keep it aside for liquid investment. You have to invest in the stated investment that has been described in the Act, RBI Act itself, how much they have to maintain and what are all the investments they have to do. It can be it should be easily convertible into cash, for example government securities and all those things. Now what happens because of that, from 100 rupees 6 rupees is already gone and 4 rupees is also gone. Now 10 rupees the commercial bank cannot touch it. Now how much they have in their hand? Only 90 rupees they have. This 90 rupees only they will use it for what purposes? Lending purposes. Then what is the point? How it will impact money supply? Guys, understand. When 90 rupees is there, they accept a deposit of how much? 100 rupees and they have to pay interest on 100. But they have only 90 to earn that. Yes or no? So their interest rates will be, the interest rates will be higher. The interest rates will be what? It will be higher. So when the interest rates are higher, again the people will be feeling, they want to feel like borrowing, or they'll be reluctant in borrowing, and it will decrease what? Money supply. Right. Suppose if RBI says it is just only 2% and here it is only 1%, means only 3 rupees gone and 97 is there with the commercial banks, and their monetary base has been improved and they will lend it at a competitive interest rates, and because of that money supply will increase. Yes or no? Money supply in the hands of the banks are increasing, so people, they will provide at what? Lesser rate of interest, and people will come and borrow money and they will use it for various purposes. So all these rates are changed with a view to what? Either to increase the money supply or to decrease the money supply, in order to what? In order to control what? Inflation, price stability, economic growth. Those are all the main aim of monetary policy. Though we have seen the same thing for fiscal policy also, understand. Fiscal policy is done by the government. Monetary policy is done by the central bank, that is RBI. Now, one more important one rate is repo rate. Repo rate refers to what? Which commercial bank borrow money by selling their securities to whom? Central bank, that is our RBI. All right. So RBI, to maintain liquidity, what they will do? Suppose in case of shortage of funds, or some emergency happens, means, so they will keep this to maintain that. All right, to keep the inflation under control, RBI uses repo rate as a tool now. Repo rate means what? First understand what is repo rate. Suppose the commercial bank wanted money. So what they will do, they will go and ask RBI, see, we wanted money for this purposes, we need urgently. So what they will do, for that RBI will charge something. That rate is called the charging. RBI is charging, no, that rate is called what? Repo rate. All right, understand here. Repo stands for repurchasing option or repurchase agreement. It is an agreement in which bank provide eligible securities as such as treasury bills to the RBI while availing what? Overnight loans. All right, and the agreement to repurchase them at a what? Predetermined price. All right, predetermined price. So if that price was higher, suppose they will sell the securities, they'll give the securities. It is simply, if I want to tell, means, okay, take the security and give me the money now. Later I will come and purchase it back. I will come and take it back. I'll repay your money and I'll take it back. For doing this, RBI will charge a rate, and that rate is called repo rate. All right. And if that rate is high, means then the cost of money available in the hands of the bank will be very high. So they will also charge very high rate of interest. Yes or no? Obviously, when you borrow at a higher rate of interest, means you will also lend at a higher rate of interest because you have borrowed at that rate. Correct. So that you can't give it at a loss. So what happens if RBI wants to decrease the money supply? Means they will charge high repo rate. If RBI wanted to increase the money supply, means then they will charge lesser repo rate. All right. So what will happen in this case? Banks get cash and the central bank the gets the security. All right. So that's what repo rate means, to give the loans by taking security as a security under agreement that it will be repurchased by the commercial banks later. All right, then for that, if RBI charge any rate, then that rate is called what? Repo rate. Next one is, the main thing is monetary policy committee. So this committee is responsible for what? Fixing the benchmark interest rate in India. So every 2 months you'll be seeing the interest rates that keep on changing. No, so that is done by whom? This MPC. All right, they will meet at least every 2 months, and they will keep on monitoring the economy and how it works, and what is the inflation rate, and whether money supply is more or money supply is less. Do we need to change the interest rates or not? They will check on that, and they'll come and keep on observing the trend in the economy. So see here, at least meetings will be held at least how many times? 4 times a year, and they have to publish their what they have taken decisions in their meeting. So RBI Act, which was amended by a Finance Act 2016 to constitute what? MPC, which will bring more transparency and accountability in fixing what? India's monetary policy. Again, it is a policy committee set up by the government. For what purposes? To look after this money supply, monetary money supply in country, to look after the interest rates that are prevailing in the country, just to suit the current economic trend. Now, objectives of monetary policy, again, rapid economic growth, price stability, exchange rate, that is currency valuation, balance of payments equilibrium, that is, when you are importing or exporting, how much you have to pay or how much you have to receive, that is called balance of payments, full employment, neutrality of money, equal income distribution, control business cycle, promote export and substitute imports. All right, so they wanted to promote what? Export, and they wanted to, they will tell you how you can substitute which one? Imports, improvement in standard of living, control of inflation and deflation. All these things are similar. All these things are similar. That is what we have studied in fiscal policy also. Yeah, but what is the difference between fiscal and monetary? See, monetary policy also aims at what? Overall economic growth, overall price stability, full employment. All right, full employment, and inflation should be controlled, and currency valuation should be improved. Right, all these things are objectives of what? Monetary policy. Fiscal policy also same thing. What is the difference between these two? Here are those. Fiscal policy means change in what? Government spending and tax rates. Okay, but monetary policy means interest rates for money supply. Fiscal policy means government expenditure, government tax rates, government public debt, that they will implement through those tools. But under monetary policy, my main thing is what? Interest rate. Interest, that is nothing but your borrowing rate in the banks to control what? Money supply. Fiscal policy is set by whom? Government. Here, who will set that? Central bank. And fiscal policy, there is no specific target because it is an overall development, right? Whenever it is required, they will do that. So monetary policy, it is a target inflation. They'll target which one? Inflation, because my main motto is to either to increase the money supply or decrease the money supply based on what? Based on the inflation. If inflation is too much though, then I have to decrease the money supply. I have to suck out all the excess money in the economy into the RBI. Yes or no? Into the bank custody. If the inflation is not there, it is in deflation. Now I have to increase the money supply. Means then what I will do? I will pump in by reducing the interest rates, by giving good, repo rates. I will charge very less repo rates so that the money will be coming into the economy. All right. So their main target is what? Inflation. Why? To increase or decrease money supply means to make, whether if it is high inflation, they will decrease the money supply. If there is any deflation or lower inflation, they will increase the money supply. Side effects on government budget and borrowing. Here, side effects on exchange rate and housing market. Of course, yes. Fiscal policy, it is on government budget. Obviously, if a deficit budget or surplus budget, yes or no? Yeah, because of the fiscal, whatever they are doing, that will impact where government ka budget or government ka borrowing. Here what it will happen, by because of that increase or decrease in the interest rates or money supply, your exchange rates or your interest rates will be affected. That is the side effects. Next one, strong political dimension to changing the tax rate. This is obviously it differs from government to government. All right, which government is there, which government is ruling, then based on their view, the fiscal policies may change. So there will be political dimensions will be there. But monetary policy, since it is controlled by RBI, it is free from political process. These are all the main differences between fiscal and monetary policies. Hope you guys understood. Thank you guys. I wish you all the best.